Hello and welcome back to the Oracle's Classroom. In the first video of this series, we took a look at the four major financial statements to be aware of. In this segment, we're going to be focusing on the balance sheet and using the Hershey company as a real-life example. So let's dig in. So to take a look at a balance sheet, we need to actually find that balance sheet. And so we should start off with how to go about finding the balance sheet, but really any financial statement that you'd like to look at. So I have Morningstar here. I use Morningstar. I use the paid version, but I'm going to show you what you can get in the free version. There's plenty of different sites out there. A lot of people use Google Finance or Yahoo Finance, and they're all really all the same. So I'm going to show you Morningstar here. So we're using the Hershey company. So we're just, we can type Hershey or we can type HSY and that will bring up the company. So again, we'll use the Morningstar here. So first thing that pulls up, just some general information on the company and the stock price charts and so forth. But what we're going to do is go right over here to financials. And then what you see is, again, some metrics. There is a summary, some summary financial statements. And what you can do is just click on the financial statement that you'd like. Expand this here. Now, the free version does not give you all of the historical data, so it populates that. But what's really great is it does give you, if I can find, oh, here we go. It does give you the most recent 5 years. Now, I don't love this, and I'll tell you in a second here. So this is in billions. So you're going to have, 0.49. So that means 490 million in this case. So you can either, if you're just trying to get a quick look for a company, this might be good enough for you. But if you're looking to do some real analysis on a business using this summary information, it's a good idea to export it to Excel. So that's one way, and I would recommend playing around with the numbers. The good thing about using the Excel download here is it does give you, just pulled this up, it does give you the actual numbers. So you can take these figures, they're in actual dollars. You can manipulate them how you'd like, do ratios, add, subtract, whatever you'd like to do, which can be a really nice thing, as well as saving it for your own benefit to create any kind of models or data resources and so forth. So that is Morningstar. Another way to get the information is through the SEC. So you can just type in SEC Edgar, and this is the government site, the Securities and Exchange Commission website, and you can, again, Hershey or HSY, and it will come up with the company's filings. You would have to search for, in this case, the most recent 10Q, which is a quarterly report, or the, if you want, you can just go ahead and search 10K, and this will bring up all the most recent 10K filings. Now, the benefit of this is it's basically just all of the data. This is scrubbed of really all the fluff that you'll see in any report. There is some nice links here, and really all you'd have to do is just go down to financial statements. There's a lot of the same numbers reported in many different places, but what you can do is just simply go down, and then it's really easy just to find whichever statement that you're looking for here. So as I struggle to find the balance sheet. So, and all these numbers, as you could probably tell, are used for a these numbers are pulled out, and this is how some of those sites get the data and import it very easily. So you can use this. Another way to get it is just to simply go, I just search Hershey company investor relations. Come right up, and you just go on here. Some companies make it easier than others. In Hershey's case, I've been on here before, of course. So you can just type in. So the SEC filings are, again, just sort of the plain vanilla, just the facts. The annual reports have sort of the chairman's letter, and in some cases, and in Hershey's case, they have the proxy statement and the 10K. So that's kind of the way I tend to do it. What's nice about the statement like this, I tend to prefer going to the company financials for two reasons. One, it can be a little bit easier just to look. I mean, this presentation here is far more visually appealing than some of the numbers that are just put into Morningstar or on the SEC report. The other benefit is when you're digging deeper, the balance sheet or any financial statement, one thing you'll notice down here, see notes to consolidated financial statements. So you may use this as the 30,000 foot view, and then it's too long for this video, but you would be able to scroll through and find additional detail, management commentary on receivables, on inventories, on any of these categories. Not all, but most of them are there if there's any additional information, which is usually important information to know. So I hope that helps direct you to where to find this information. Like I said, it's always out there in many different places, but I like to go directly to the primary sources, because ultimately those other sites are getting their data directly from the company. And so why not go directly to the source? Because as things go to Morningstar and other places, you can lose, in some cases, just because of the way that they do the data, lose some information, and you don't have those notes as well, which are very important. So now that we've actually found the balance sheet, let's take a closer look at some of the specifics of this statement. So the first thing that you're going to see, that you should see on every balance sheet, is the name of the company. It should list, say something to the effect of, consolidated balance sheet, just balance sheet. It might say statement of financial condition, but the key is that it is a point-in-time snapshot of all these balances for the company. Then it should tell you if it's, in this case, it's in thousands. So that means that, we could just simply add 3 extra zeros to these numbers to get their actual. And that's typically what Morningstar will do, because companies don't give those last 3. They usually just stop at those at the thousands digit. So you have that. You'll have the period, which it is. Now, with a balance sheet, really with any financial statement, it doesn't have to be any particular time period. In the case of a balance sheet, it's a point in time. So it's usually, in this case, it's the end of their year, which is December 31st, 2019, and then there's 2018 as a comparison. But it could be quarter end internally when they prepare these for their own use. It could be any date, really. It's really just when that snapshot in time is put together. And again, I referenced earlier, so I don't think it showed up on the screen because it didn't scroll up. See notes to consolidated financial statements. So that's just reminding the user of the financial statement that there's much more that goes into this. This is the 30,000 foot view, and to fully understand the company, you need to dig in to the notes. So most balance sheets, at least in the United States, are set up this way. You have, just broadly speaking, assets, at the top of the balance sheet, sometimes referred to as the left hand of the balance sheet if they're prepared side by side. So assets, and then liabilities and stockholders' equity. Now these are together, even though they're two categories, because the assets are independent of financing source. So we don't know if the buildings were bought by cash, were they bought by debt. That doesn't matter. It's who and what categories of sources of capital are putting up that capital to purchase or finance those assets. So that's why these are lumped in together. If a business had no debt, it would just be all equity. So in this bottom half of the balance sheet, again, sometimes the right-hand side of the balance sheet, it's referred to, this sort of first subsection here is the liabilities, and we'll dig into that in a second. And then the stockholders' equity, again, is broken down in this case into different categories. So let's dig into some of the specifics of the Hershey Company balance sheet. Now, one thing that's helpful to do even before you look at any particular financial statement is just think about the company. What business is it in? What do you expect to find? Now, of course, I've already looked at the Hershey Company, but you can make an approximation for what you'd expect to find just by thinking about the business. So, every single business is going to have cash. Hershey, you'd expect them to sell product to different stores, maybe on terms, which means that they're selling on credit, not for cash. And so they're going to have some money due to them, which is accounts receivable. So not surprisingly, we do see a line for that. Hershey, of course, has large amounts of inventories, which this figure can get broken down further into work in progress, which for Hershey's might be sugar, cocoa, butter, that kind of thing, as well as finished product sitting on their own warehouse shelves, getting ready to be sold. And then prepaid expenses, those are some things like prepaid rent or employee advances, things like that, insurance where they pay the premium up front, but it hasn't been used yet, that kind of thing. And that first, so those four right here in total make up total current assets. So the assets section is delineated into current assets and non-current assets. And current assets are simply those assets which are expected to be turned into cash, if they're not cash already, within the next 12 months, the coming 12 months. So then we move on to non-current assets. So we see property, plant, and equipment. This line is simply the fixed assets that Hershey has. And again, we would expect to see a pretty big number, as Hershey is a manufacturing business with large plants, including their Hershey Park in Hershey, Pennsylvania. Increasingly, we've seen the Goodwill and intangibles lines on balance sheets really take up an increasingly larger portion of the total assets of a company. And the Goodwill figure is really just a plug number that arises when one company buys another and the assets need to equate to the purchase price. So that's really just the plug number that gets put in there. The intangibles could be made up of many different things. Oftentimes, when another company is purchased, they quantify the customer lists as intangible assets. But these could also include patents. They could include other intellectual property, brands, things like that, which are intangible by nature, but separate and quantifiable and distinct from goodwill. Now, the other assets category, again, you're going to see this on just about every balance sheet. Usually, the company will provide a breakdown of what is in that other category. The biggest thing here is just to make sure that it's not too big in relation to total assets. It's really can become a dumping ground and an abuse. Things can be hidden there. But You should treat it with some skepticism, but not get overly concerned about it. But you should look into it. Deferred taxes, simply net tax assets. We won't get into what those are, but in this case, they're pretty small for the Hershey company. So that's the total assets segment, and we can see Hershey here again, remembering that the statement is in thousands, has total assets of just over $8.1 billion. And again, when you get into ratio analysis, you might want to take a look at trends over time, but you might want to look at what percentage of the fixed plant is of total assets. Again, the Goodwill and intangibles here, make up over $3 billion of the $8 billion of total assets. So you want to make sure that those, put some thought into them. And then again, you can do ratio analysis with inventories, accounts receivable, cash to total assets. Really, anything that you'd like, you can sort of suss out different trends in a company over time. But that's really, what we're focusing on here in this beginner video is really just the what. Here's what you find. Here's what you'd expect to find. And in Hershey's case, the assets, which we've covered, really pretty typical and what we would expect to find for Hershey. Moving on to the liabilities and stockholders' equity section, the right-hand side of the balance sheet, we'll start with the liabilities, and just like the assets section, the liabilities section is broken up into current liabilities and long-term liabilities. So the current liabilities are listed first, and generally, I should have mentioned this at the beginning, the assets and liabilities are usually listed in the order in which they are convertible into cash. So, on the asset side, cash is listed first, and down to, plant and goodwill, which is less, not as easily converted to cash. And so same with the current liabilities. These are due within the next 12 months. And so most companies have these accounts here. Hershey's pretty simple. So we have pretty much a basic balance sheet for a multi-billion-dollar company, which is great to learn from. So the accounts payable, these are simply amounts due. It might be due to suppliers, which they haven't yet paid for, that cocoa, the sugar, the butter, any ingredients, packaging, things like that. Accrued liabilities, slightly different. These might be monies due to employees. If you get paid every 2 weeks, or even weekly, you're incurring that wage, but it has not yet been paid, as well as maybe accrued rent, things like that. Accrued income taxes, same thing. As time goes on, you incur the tax, but you have not yet paid it, so it sits there on your balance sheet as a liability. Short-term debt. Here's where we get into the actual specific borrowings of the company. And so these first couple are what are often referred to as spontaneous liabilities, because they just arise in the course of doing business. You can control them to some extent. Walmart does this by delaying payments to its suppliers and so forth. But generally, eventually the bills have to come due in a typical, maybe 30-day window, and even shorter if it's a wage. But the actual debt represents borrowings of the business. And, one thing that just jumps out immediately here, we look at short-term debt, this change from 2018 to 2019, it's something that you would want to look into if you were looking at this balance sheet in greater detail. And we can do that in a more advanced video. But for now, short-term debt, and then the current portion of long-term debt. So short-term debt is, maybe a line of credit that they have that they just borrow, or perhaps commercial paper, which is basically the same thing, which is specific short-term debt. Current portion of long-term debt is simply that payment which is due on their long-term debt that's due within the next 12 months. So we can see here that Hershey will have about $2 billion of liabilities that they need to come up with $2 billion in cash over the next 12 months. And without getting into the ratio analysis, we can see that they could meet that with the current assets that they currently have. For any other company, that might be pretty tight, almost a 1-to-1 ratio. But Hershey has significant and stable earnings, which allows it to get a little bit closer to the line. Next, long-term debt. Here's again, it could be a mortgage. Usually, in a company's case, it's a long-term public bond that they've floated. And again, you just sort of think about what you're seeing here, and these numbers should sort of, as you get into it, you'll start to get a feel for, okay, well, $3.5 billion. Well, geez, they have $8 billion of assets. How does that compare? How much short-term assets do they have to cover this debt? And again, without getting too far into it, what are their earnings? So these numbers should not be taken as good or bad in isolation. Really, the meaning comes in when you start to compare them to other accounts. And we'll compare it to equity in a minute here. Other long-term liabilities, again, kind of like the other assets, it's this other section that they can lump them together. In this case, it's about 10% of the total liabilities, so it's not huge, but there is detail available on what that is comprised of. Deferred income taxes, again, without getting into too much of the detail, the differences arise between tax accounting and generally accepted accounting principles, or GAAP accounting, where for various tax reasons, companies may not have to pay the tax yet, and so they incur it on the financial statement as something that they will owe, but it hasn't yet gone out the door. So you might hear some companies, some towns give tax incentives to certain businesses, or one of the biggest ones is accelerated depreciation, where a business is able to write off for tax purposes the expense, the depreciation expense, to recoup their investment faster. But for GAAP financial purposes, it's more of an economic view, and so it's paid later. But that's still a liability that the company will owe. So we can see that Hershey has just about $6.4 billion of total liabilities, and you might get uncomfortably say, okay, well, some other entities other than owners have put up $6.4 billion to fund the $8 billion of assets. So that seems like a high amount, and it is. We'll continue on to the equity section. And here we are at the equity section of Hershey's balance sheet. And one thing you'll notice right off the bat is just how big this is. Typical balance sheets might only have 1 or 2 lines, a few lines. In Hershey's case, it looks big, but really, the first number I typically just instinctively jump to is total stockholders' equity. So about 1.75 billion. But you can just start at the top. It can be intimidating at first, but really you just kind of work your way down. So in this case, Hershey has preferred stock, which is authorized, but none has been issued. They have common stock, and they actually have this Class B common stock. One little particular quirk of the Hershey company is that the Hershey Trust owns a controlling interest in the Hershey company, and just an interesting little historical fact. One of the biggest owners of Hershey was set up by Milton. I think it was Milton Hershey for the benefit of a trust which helped orphans. In any event, we continue on. Additional paid-in capital. That's simply usually companies have a par value of the stock, and they have this additional paid-in capital above the par. It's really sort of just a hangover from the old days when companies had this authorized par value and share capital, but really you can just kind of lump them together. Treasury stock is stock that has been repurchased by a company, And then other accumulated other comprehensive loss could be income, but this is sort of an other category which balances the balance sheet by there might be things in there such as hedges on the cocoa that they're buying, or a hedge on an interest rate contract. Those kind of things usually don't flow through the income statement. They kind of just get lumped into this other section. And then you have the total equity for the Hershey company of this 1.7 billion. Most companies, a lot of companies have these non-controlling interests. That's just simply some minority partners that some owners of businesses maybe that they've acquired that have maintained an ownership interest in those businesses after selling it. So Hershey controls it, but the non-controlling or minority holder, with Hershey being the majority owner, it has to be accounted for somehow. So in this case, it's a really small $6 million figure. So if you're buying into the Hershey company, the Hershey, you're buying into this bucket here, this total stockholders equity. That's what you would have a claim on. The company itself has equity capital of $6 million higher, and if it had preferred stock, that would also be listed here too. So in Hershey's case, just sort of a teaser, but okay, what do you do at this point? You start looking at ratios. You start looking at comparison and analyzing these numbers both in greater detail as well as among themselves. So if we just use round numbers, just round stockholders equity up to 2 billion compared to the 8 billion, that's 25% of the company's total assets are funded by equity, and the 80% are funded by either debt, liabilities of some kind, whether these spontaneous current liabilities or the actual true borrowing. So again, first glance, if you were to show me this balance sheet and I did not know it was the Hershey company, it'd probably be somewhat alarming to see a ratio of 4-to-1 debt to equity, especially considering that a big portion of the assets are Goodwill and intangibles. So in Hershey's case, the Goodwill actually swamps the equity category. Now, Hershey's a pretty special case. It's a business that has a dominant position in the candy industry. It has stable and consistent earnings, so it's able to push its balance sheet to such a degree that other companies usually can't get away with. But it's still important to know. It's still important to understand. And, things change. And again, the balance sheet being a point in time, you really want to get a handle on the full picture of the business. And to do that, you have to take a look at the income statement, cash flows, how equity is changing over time. And we'll continue that work in future videos. So thank you so much for watching. Please continue the conversation in the comments section. Please, it would really, really mean a lot if you liked and subscribed to the channel, share the video. Please let me know, if there's anything I missed, if there's anything else you would like to know, if we can dig into the Hershey company together, there's any specific accounting or investing concepts that you'd like covered, really could use some ideas from you for future videos, and would love to know what you think. So thanks again, and hope everybody has a great day.